Let's get to the markets now. Joining us, Alan Nuckman of St. Paul Research, a division of Agora, and he's been tracking these markets. We're coming to the end of the first quarter, and Alan, it's been kind of an interesting stretch here. You know, we've kind of seen this transition in the market from the winners of 2020 into this new classification of recovery winners. What has stood out for you in the first quarter of the year?
We're essentially sideways, but I think that the level of anxiety in investors is much higher than what you see in the market. The VIX went below 20 here in the last couple of weeks and went down to the year lows. But talking to individuals, their concern level seems to be so much higher, even though if you look into the future, if you look to the GDP growth they're looking 5, 6, 7, 8%. You're looking at earnings numbers that are going to expand exponentially in the next quarter. So there's a level of fear in people's minds, or concern, I guess, that is unfounded by the fundamentals for now anyways.
Just to play devil's advocate, because certainly there's a massive chorus of people out there that are sort of beating this drum of an economic recovery. But we've had some challenges, to say the least, with respect to dealing with COVID in this country. The vaccine rollout, the latest news with AstraZeneca. We're seeing variants across the country. I don't have to tell you what the director of the CDC said yesterday in the United States. Even with the successful rollout of vaccines, still some very big concerns about the rising number of COVID cases. Is there a possibility that we're all getting ahead of ourselves on just how much economic growth is potential if we get later in the year and we're still dealing with COVID, and it forces us to reevaluate how we're going to sort of navigate through this pandemic?
So I'm paid not to think. I'm paid to take advantage of what I see. And what I see, I can only focus on one thing, and I can only focus on price. This price recovery is unprecedented. We had a 100% rally in tech off those lows. The S&P obviously is at very close to its all-time highs and pressing at that 4,000 level that we talked about in the past as a target. And the Dow is sitting at its highs. So the markets are a reflection of the reality. And right, I guess there could be a surprise out there, but I've been taught in my 30 years to follow the markets. The markets are right more times than not. So the markets usually have it right, and we'll talk about that when we talk about interest rates in just a few minutes. But if we look at what's happened in the last 30 days, all this talk is about tech right now, because tech is off its top, and it's been 6 weeks since the all-time highs. Think about it. It's been 6 weeks since the all-time highs, and there's this level of anxiety that's so unprecedented. Now, if you look at the last 30 days, the NDX, which is the tech top 100 that I talk about, the NDX is sideways, absolutely sideways, not up, not down. And if you look at 2021, the NDX is unchanged for the year. So yes, we pulled back, we had a little drop from the top, but that's happened many times in the last decade. And each and every time the markets come back and made new all-time highs. Now, let's talk one quickly. Last time we talked was March 2nd. So essentially nothing's changed since then in tech. We're just sideways. But there was a low on March 5th where it made new relative lows and then had a higher close. We haven't tested that low again. So as soon as we can close above 13,000, which is the midpoint of this drop from the top, 13,000 on a weekly basis, I think the worst will be over. And every time in history that's happened, we've had a full V recovery. The distance of that fall on the old highs, that targets a 20% move from where we are right now.
Well, that's helpful context, and let's segue into what the bond market has been saying, which kind of speaks to what you were saying. Like, you look at what the market's doing, what might ultimately happen. It's been a pretty weird time. Now, this is a holiday shortened week. We are expecting that President Biden's going to have more to say about this next round of stimulus, the infrastructure spending, and it seems like the bond market is looking at that and going back to their story of, well, I think it's time to push up the 10-year Treasury yield. And since that's been happening, sort of this typical reaction in tech stocks has been a bit of a pullback. But I guess we're all sitting here, and it's not like the central bankers have budged much. They know what the bond market is doing right now. For now, they are not pulling forward planned interest rate hikes. And so I do wonder how this standoff is going to play out when it comes to the tech stocks that you're seemingly somewhat optimistic on, which have sort of been caught in the middle of this?
And really, what you have to think about, do you believe in Apple and do you believe in Amazon? They're down at some super support points. They're off their highs. They haven't participated. And to bet against those, I think, would be, treacherous. Let's talk about what the market's telling us instead of my opinion, which, is just my opinion. If you look at the futures markets, the future in the futures markets, the Eurodollar futures, which are short-term interest rates, which are pushed by the Fed. Remember, the Fed can only adjust short-term interest rates, and then that follows all the other, rates in the curve follow. So if you look at that, the Eurodollar futures, 2023, they're pricing in a 0.5% hike, 2024, 0.5%, and 2025, 0.5%. So right now, the Eurodollar futures are at 0.25%. So add all that together, and that's still below 2% as far as short-term rates go. Yes, the 10-year is going to, be different than that. But again, the 10-year is for 10 years. Right now, even with this bump up that we've seen, we're at 1.7%. Who's going to put their money away in a 10-year note for 1.7%? That's below inflation. I'm not the one saying it. There are people much smarter than I have that said that's just a stupid trade. Now, no trade is stupid as long as you have a plan. But some very famous hedge fund guys have been saying it's a stupid trade at this point.
Well, I guess against that back, it'll be interesting to see whether or not sectors that did come back in a big way as tech lagged. I mean, tech, you mentioned Apple. Yes, Apple gives some of its money back to shareholders, but they've got a lot more to give if they decided they wanted to do that. There are a lot of technology companies that don't cater to dividend investors, but there are a number of sectors, banks would be a great example, which historically have built their, investor model around having shareholder-friendly stuff. So if you're not getting what you need in the bond market, is there a component of stocks that will find interest through the year because investors just aren't getting what they need through fixed income?
Yeah, and that's been the story for the last decade, that the yield on the S&P has been greater, significantly greater than what you can get in treasuries. And until that choice changes, there's still going to be that demand for stocks, in my opinion, because not only do you get the dividend yield, but you get the possible appreciation. The last time we talked, I mentioned a couple of super boring stocks, and I mentioned AT&T, and that has risen from 28 to above 30. Now, the way I trade with options and actually in the money options, a very small move in the underlying stock can have a big payoff in the option. And that also happened in U.S. Steel. We mentioned that. U.S. Steel went from 15 to 25, made new highs there. So, there's a couple of old school stocks. And for me, it doesn't matter what you trade, it's how you trade. And I see opportunity and I see a lot of risk reward now shifting back to tech stocks that actually gotten a little bit overdone, needed a break. Again, I can't say it enough. The NDX had rallied 100% straight up. So at some point it needed a stall and a consolidation to regroup and re-energize. And from risk reward, there's a lot of tech stocks that I find very attractive at these levels.
Watching the swings of the market. It's what you have to do. Alan, thanks very much. Always good to get your perspective. Alan Nuckman joining us, Chief Market Strategist at St. Paul Research.